Okay, today we are going to discuss this topic, sustainability reporting and integrated reporting. Now, before I start speaking on this topic, let me discuss a little bit of background and few more concepts, and then we will try to connect the dots. Now, we know that we are talking about commercial organizations. Mostly we are discussing the financial reporting in commercial organization, in businesses. And what is a business? If you check the definition in the dictionary, it says that a business, which it is an activity which has the underlying idea of making profit. So it's an activity which is taken up to generate profits. So profitability and profits, this might not be the only objective of a business, but this is one of the major objectives for which people they invest their money. So profitability is there. Okay. Based on this thing, when you prepare your financial statements, so the last line of your income statement is the profit, and that is called bottom line. Okay. We call the word profit as bottom line of the business. And you know that bottom line, it is in the literal meanings as well, because this is the last line, and it has some other philosophical meanings as well. Like we say, what is the bottom line, which means how much profit did you make? So long ago, profitability was the only objective, and there was only one P, which relates to profit. But something like 25 years from now, back 25 years, businesses, their scope slightly changed. The expectations from businesses, they actually became more wider. And we started calling it triple P bottom line. There a new terminology, it came up, and we call it triple P bottom line. So there were three Ps, and the three P are people, planet. So there is one consent about people, so which means society, everyone, the stakeholders, the planet itself, which means the environment, and the profit. So it means that today, when you prepare your financial statements based on IFRS, you actually are only reporting this part, profitability part. Whereas in reality, there is much more expectation from a business other than only to generate profit. So we say that now we don't only talk about P, one P, we talk about three Ps. We call it triple P bottom line, and triple P means people, planet, and profit. So this is one piece of information I wanted to share with you. You keep it on one side, I will connect it later on. The second idea which I wanted to discuss in management, we talked about different theories. And the first theory was, we call it Stockholder Theory. Stockholder Theory. And this is the concept which we are actually talking about from management. It is not from financials. Second theory was Stakeholder Theory. So first one was stockholder, and the second one is stakeholder. And we know that stakeholder is a much wider terminology. And the third theory, we call it agency theory. This is again a small piece of information. I'm going to give it to you, and then I will connect the dots before I actually start my topic, sustainability reporting. So this was the oldest one, Stockholder Theory. And this is what came as a modern one. So stockholder means shareholder. Stockholder mean the owners, the shareholders of the business. So under the stockholder theory, we said that, and this is actually about the role of directors and expectations from directors. So these three theories, they come under the topic, they come under discussion when we are talking about the management, we are talking about the directors, what they are expected to do. So under the stockholder theory, we said that directors, they are supposed to protect the interest of the stockholders. So which means that the management is working only for the shareholders. And if they are working only for the shareholders, it means that the only focus is on profit maximization, because what shareholders they need from a business is profit maximization. So stockholder theory had a very narrow viewpoint. It was only focusing on profitability maximization. It was only seeing the business as a vehicle to, maximize the gains and economic benefits for the investors. A little later, we realized that shareholders are not the only people around. There are other people as well. There are employees, there are customers, there are suppliers, there is community, there are so many other things, and there are so many other stakeholders. We started using a word, not stockholder, but we said stakeholder. And we said that directors are there to create a balance, between the needs and objectives and expectations of different stakeholders. So you cannot just focus on shareholders' profit maximization. You also need to see, how do you treat your employees? What are the expectations of employees? Customers are there, suppliers are there, community is there, government is there, society is there. So stakeholder is a much wider perspective, and the directors, they need to create a balance between the needs of different stakeholders, because there is going to be a conflict. Because when your employees, they come in and they say, we need a pay rise, we need a bonus, we need some increase in salaries. So when you increase the benefits of your employees, ultimately your profits, they go down. So shareholders might not be happy, because when you say, I'm going to give a $2 million bonus, so it means that 2 million will be taken away from the shareholders and will be given to the employees. The same happens that when you decide to, you said that I'm going to put some water treatment plant, I'm going to protect the environment. So you are considering environment as your stakeholder, and you want to fulfill the needs of that stakeholder, which is called environment. And in order to protect the environment, you decide to replace, with some modern machinery, which is low carbon emissions, probably protecting environment, water treatment plants, smoke treatment plants, etc., etc. So again, you need to invest money in these ventures. So it means that the profitability of shareholders, it will go down, and shareholders will compromise or sacrifice to some extent, so that the management can fulfill the needs of other group of stakeholders. So there is always a conflict between fulfilling the needs, because whenever you are giving someone, so actually you are taking from some other. So you take from someone and you give it to someone. And this is the role of directors, that they create this fine balance between the needs of these different groups of stakeholders. This is stakeholder theory. Actually, we need only these two for today's lecture, stakeholder and stockholder, because that is what explains the background, that where this sustainability reporting is coming from. The third thing, which is here, is agency theory. I will just speak a little word on that. In agency theory, we say that directors are the agents and the shareholders are the principals. And you know that agent is someone who works on someone else's behalf. They have got their own benefit as well, but ultimately they are working on someone else's behalf. So we say that directors are actually working for them. They are agents from the principals, who are the shareholders. So actually directors are working for themselves. When they are, working really very hard to improve the performance of the business, it is not just that they want shareholders to make a lot of money. It is actually they want their own contracts to be renewed. They want their own bonuses. They want their own, contracts being extended. They got more power. They get more money. So directors are agents. They are independent agents. They have their own interest as well, and they are also protecting the interest of the principals. So now agency theory has got quite a long discussion, but we don't need it today. I just gave one short line, and then you can continue it somewhere else. I mean, in some other course. So we are actually focusing on stockholder theory, stakeholder theory. I give you two concepts here now. One is the triple P bottom line. Second is about this, profitability, business profit, and whatever, stockholder, stakeholder theory. So two pieces of information I have given you. Now, there is a third piece of information which I also want to discuss, and then I will connect these three things and then we'll start our today's topic, which is sustainability reporting. Actually, there is one more as well. There are so many things which we need to discuss, that why this topic or where this topic came from. What is the history, philosophy behind that? You see, when you see an organization, so far now you guys are, how to say, accounting and finance professionals. Your focus has always been on IFRS, and you think that you are champions. I mean, you are smart guys, you are managers, you are finance managers. I don't know who you are, but you think that you are champions. This is the organization which I made. You know what? Organization has this production department, it has sales department, it has admin department, it has marketing department, it might have some R&D department, it might have some logistics department, and then it also has this accounting department where you are. And within the accounting department, what happens? That there is financial accounting, there is management accounting, and there is tax accounting, and there is finance as well. So finance or financial management or management accounting I put together, then tax accounting. So let me call it like this: management accounting, tax accounting, and IFRS accounting. So when you learn your IFRS, or what you are doing IFRS, here, you are actually focusing only on this part of the business. Let me color it differently so that you can see it. This part of the business. This is your IFRS. So IFRS actually, so when you say that I'm going to depict the position or a situation of a business, I'm an IFRS expert, and I am going to make financial statements, and my financial statements will or would reflect how the business is doing. It's not a very true statement, because you are only focusing in this area. Business has many other areas as well. So this is this is actually one of the reasons that I have seen many times that people come from audit background. They have been auditing financial statements. Then they join the company, some other company. So you spend 5 years, 6 years in some audit firm. You come down to a business as CFO. And then when you become CFO, your responsibilities are huge. CFO is not only about financial reporting. CFO has to have an overview of the entire company. And this person who is coming from the audit background has got only IFRS knowledge or practice, whatever. And then he becomes responsible for this entire thing. And here the trouble starts, because you have been focusing you had a very narrow focus IFRS. So managing an organization or the performance of an organization is a much bigger thing than just your financial statements. I mean, IFRS, you can see it is just lying in this part. There are so many other activities happening in the business. So this is another problem, that IFRS reporting financial statements. And there is one more thing as well. Financial statements mostly talk about the numbers, and the numbers in the past only. So focus is even lesser. You talk about what? You talk about numbers only, financial performance mostly, and you talk about past. And based on those only numbers and only past, giving some prediction or forecasting or, about the future is not really very a good idea. So if you want to understand the success of the business, or, how the business is expected to perform in future, depending on the financial statements is definitely not a very good idea. It is absolutely not a very good idea. So it means that we have to, so financial reporting, the purpose of financial reporting is to help investors to make decisions. What was the purpose of financial statements? We said that initially in the first definition, the purpose of financial statements, objective of financial statement is to help users to make economic decisions. But when you see this diagram and you say that, maybe there are many other things which we need to consider. Financial statements alone are not enough to understand a business, its current progress, its future expectations. So we need to, somehow enhance or make a wider angle. We need to make a wider perspective and involve a wider perspective into financial reporting. And these are the things which have been added in last 20 years. I mean, you go back 20, 25 years ago, these things were not discussed. These things were not expected by finance departments. These things were not expected by financial reporting. These are the things which have been learned by the mistakes. Oh, I depended on financial statement only, and financial statement did not focus on that area. Financial statement did not focus on the risk. Financial statement did not focus on, environmental issues. They did not focus on the risks which we'll face in 1 or 2 years' time. So we made wrong decisions because the information which was coming from the finance department had a very narrow focus. So this is the third thing which you need to consider. So one piece of information about a focus from people, planet, and profit. So triple P, then stockholder and stakeholder is another piece of information. You keep it in your mind. And then what IFRS is doing, making a very narrow perspective here. So these are the 3 dots. Actually, there is 4th as well. I'll discuss this a little later. These are the 3 main things, okay, before I start the topic. Now, considering this thing, now we understand now that the financial statements which we prepare and we call it financial reporting, this is not addressing the needs of this people and planet and profit. And this is not addressing the needs of the stakeholders, a group of, multiple groups of stakeholders. And it is also not giving an overview of the business. So these are the 3 deficiencies which we face. Now, considering this thing, then comes the word sustainable reporting. So you've got financial reporting. So apart from financial reporting, you also talk about now something different, because financial reporting will remain financial reporting. That will remain financial statements, but we need to speak about few more things as well. Now, what are those more things and what type of reports will be there and how do we report them and how do we name it? We say, okay, the other things, we put them under the term sustainable reporting, sustainability. Just ignore this word 3.2. This is written as a mistake. So sustainability reporting, the next idea comes up. Now, the word is sustain. Sustain, sustenance, sustain. Sustain means to remain or to exist for a longer period of time, to exist in future. So something which is sustainable means that it can continue to exist, okay? So sustainable reporting idea comes in, and in this thing, we are going to discuss all those things which we said that they are necessary, but they were not included or they were not covered in our financial reports. So let me just pick up the color here. Okay. So we start. We say that sustainable reporting, as promoted by the GRI standard, this is Global Reporting Initiative Standards, is an organization's practice of reporting publicly on its economic, environmental, and social impacts. So economic is on the financial side, environment, like we said, planet, and social impacts, and hence its contributions. And by the way, when I say CSR, social impacts, so there is another topic which you might have read before, CSR, corporate social responsibility. So we are not going to discuss here, but social impacts, they usually come under corporate social responsibility, and hence its contributions. Contributions of whom? Contributions of the organization. So organization's contribution, not only to fill the pockets of the shareholders with dividends, but how an organization is contributing positively or negatively towards the environment and towards the social impact. Cigarettes manufacturing. So they are very profitable companies because cigarette manufacturers, they have very loyal customers who do not switch the brands. Once they make a customer, they expect that customer to buy from them on every day morning, wake up, start smoking until you go to bed, and you smoke the same brand, you smoke this, and it is very hard to switch the brand. So it's like, such a luxury you have when you are selling cigarettes, because you've got customers who are in millions in numbers and they are dead loyal to you. So you've got, probably you are making a lot of profits. So economic side is very good, but how much or what it is causing to the society? A negative impact. So positive or negative, and you need to calculate those impacts. You call it accounting profit. You might have an accounting profit of 1 million, but then we talk about the overall benefit by the economy. Economy might be losing $5 million because these people who buy and smoke cigarettes, the shareholders, they make profit, but these people, they become sick. When they become sick, they go to the, they are being provided by the medical treatment, and there is a cost of that medical treatment. The cost of medical treatment probably is 6 million. So your accounting profit might be 1 million, but the overall, this activity of manufacturing and selling and smoking cigarettes, how much it is costing to the economy in itself. Because on one part, by selling, there is a profit, but then on the other hand, there are some repercussions, and those people, they need medical treatment, which has some cost. So you need to understand that businesses, they do have impact. So you talk about, any other businesses which are damaging the forest, you are cutting the trees, you talk about paper. So today we don't have, most of the paper which comes today is for purpose grown forests. So I don't think that today forests are cut for making papers. Most companies which are paper manufacturing, they grow trees for making forests, for making paper themselves for that purpose. But in past, trees were cut, and trees are still cut for many other purposes. So when you cut a tree, somebody makes profit, they make profit, but then the environment is getting damaged. So we need to see what the idea of this GRI, Global Reporting Initiative, is, that these businesses which are making profit, how much loss they are causing, or otherwise probably they might have a positive impact as well. So what is the positive and negative impact of these businesses on environment and on society? So this is the main idea. So Global Reporting Initiative, sustainability reporting now integrates environmental, social, and economic performance data and measures. Sustainability reporting is often now considered to incorporate reporting on corporate governance as well. So that area, like I told you, that within the business, you have many different parts. This is IFRS, but how do you manage and run the business? IFRS means how do you record and report the financial transactions? That's it. IFRS talks about how do you record and report the financial transactions. But in business, you do not have only financial transactions. You have other activities as well. So how these other activities are performed, how businesses are managed, that comes under corporate governance. So sustainability reporting also talks about not only outside issues about society and environment, but in general, how the business is managed and run. Because if a business is not very well or properly managed and run, it cannot remain sustainable for a longer period of time. A bad governed business, ill-governed business cannot remain competitive. It will face risks, it will face competition, it will face challenges, different types of challenges, and it will not be able to, successfully compete with those challenges, and ultimately the business would fail. So therefore, corporate governance is an essential issue, because corporate governance makes sure that everyone is happy, everything is done properly, and we are secure, and we are keeping the business secure for the future. Because if a business has weak systems or weak corporate governance, it cannot grow, and it cannot compete, and it cannot survive for a longer period of time until or unless you build in systems of governance. Now, what is sustainability reporting? Again, just ignore this 3.2. This is my mistake. Actually, not my mistake, my staff's mistake who made these slides. Okay, so core values of sustainable business. We say, okay, you know what? Idea is here, sustainable business. Because we say that if a business is fulfilling the needs of all these stakeholders, and if the business is addressing all these issues, only this business will remain, will continue to exist for longer periods of time. So sustainable business, economic viability, environmental response. So economic viability, they should be there. Business should be making money. It should be a profitable thing. It has some environmental responsibility and it has social accountability. Because if you do not have environmental responsibility, sometime sooner or later, you will be fined, you will be penalized very heavily. And you will have a bad name and bad reputation, and you might lose customers, because if you are damaging the society or if you are damaging the environment, not only that the government will put fines and penalties on you, but your clients and partners and customers will also not put you in the right place. And you have noticed many times that a lot of companies today, they sell their products, and on the packages, on the packaging, they write down that it is, the packaging is made from recycled paper. So that is a sign of that we are socially responsible, we are environmentally responsible, we are using this recycled paper, recycled, packing material or whatever. And they convey this message. And why do they convey the message? Because that company will have a better image. Customers like this. I mean, at least the aware customers from the modern societies, they pay attention to these things, that these companies are making money, but how are they destroying the environment in which we live? So sustainable. So it's not only that it has legal issue is there. If you are violating some environmental laws, sooner or later you will be legally penalized. That's on one side, but you also lose customers. So social accountability, environmental responsibility, economic viability. And who do we have? We say regulators and policymakers. So you need to work with the regulator and policymakers to follow these. So we work with the regulators and policymakers so that we do not violate any laws. And we also know that what new laws are coming, because they might go to impact us. I mean, we know that. I have seen this thing that in Europe, what happened that cars, they came in and you call them, standard 4 or standard 5, and the old cars, and which had more carbon emissions. They cost you more taxes, more payments in taxes, and sometimes they were banned, and you have to change the fleets, etc. So you need to understand what are the policies coming. You need to work with and pay attention to the general public, and not about the general public only. Also, you need to consider about the future population, how your business is going to impact the future population. Banks and shareholders are there. These are the providers of finance. And local communities you need to work with, etc. Customers and suppliers is one group, employees is one group. Actually, when you see that, when we said stakeholders, I didn't go into more detail because I thought you already know, but I'll just list it down. You've got 3 types of stakeholders. You call them internal stakeholders, external stakeholders, and connected stakeholders. So you've got internal, external, and connected. So which you call them as sources of finance. So your internal stakeholders are, sources of human resource, your managers and your employees and whatever. We call them internal stakeholders. Then you have sources of finance, which are bankers and shareholders. And then you've got external stakeholders, which are tax departments and legal and, governments and so on. So business need to work on all of these things, we understand. So businesses were working with them, but we need to integrate or incorporate our activities or our actions with regard to all of these areas inside of sustainability reporting. So sustainability reporting means that when whatever are your activities, or how you are managing your relationships and how you are managing your responsibilities with not only with the stockholders, but with the other group of stakeholders. And that is what sustainability reporting is about, that It reports your actions, a business actions or a business activities, which will have a positive or negative group on a positive or negative impact on these group of stakeholders. So the growing awareness of the part that business has to play in sustainable development has led to stakeholder expectations that quoted organizations will make these disclosures. So these usually apply to public limited companies. These usually apply to large companies, listed companies, which are quoted company, we call them. And they make disclosures that how their activities are impacting positively or negatively to the environment. I tell you from my experience, when I was working, because I worked in oil and gas is a very sensitive area, we had different sites. And on our different sites, unfortunately, we never had electricity power, or we never had water supplies or gas supplies. Gas was never needed actually, because these sites are remote sites. And on those remote areas, you don't expect power lines supplied by the government. There is no population around. It is somewhere in the middle of the desert. It is somewhere in the middle of, like, it is on, somewhere in close to probably mountains. You don't know where it is. So these sites are remote sites, and we have to, produce our own electricity. We have to buy very huge generators, and we had to, make supply of our own water to be used, water to be drunk. And then we had to calculate and provide the numbers that, what is our power consumption or our fuel consumption per person, because we were using diesel, we were using, petrol in these generators. So what is the consumption of diesel and petrol for which number of people? And we were given the targets that we have to decrease this consumption. It's not that it is my money and I will burn as much fuel as I want. It's not like it is my money, I can throw water which I want. So we had to actually calculate the consumption of water, calculate the consumption of diesel and petrol on our sites, which was provided to our people. And we had to find ways how to decrease this consumption, not because that we wanted to save money by decreasing the consumption, but because we had targets to meet for environmental standards. So this is what businesses, and they have to make disclosures about that. They have to make disclosures about that. You have heard these words a lot: carbon footprint. What is your carbon footprint? What is your environmental footprint? Environmental footprint means that how you are changing the environment. What changes are you causing in the environment? What is your carbon footprint? How much carbon you are emitting into the environment? So sustainability reporting is key part of a company's dialogue with its stakeholders. In fact, stakeholders' desire for and expectations of such information is so strong, companies that fail to make sustainability disclosures will likely now be at a significant disadvantage, because investors will not invest money. They will feel short of capital. They will not find investors. They will not even find customers, because customers, investors, everybody is paying attention which company is protecting the environment and protecting the society, and which companies are only making profit and damaging the environment and damaging the society. So these are expectations are becoming, how to say, significantly, they have changed over a period of last 10 to 15 years. Environmental accountability, we call it. Stakeholders expect businesses to environmentally responsible. This means not only being aware of the effects of business activities on the environment and how to mitigate them, but now increasingly to be developing business strategy that is environmentally sustainable. Like 20 years ago, we never thought about it, that when we make our business strategy, we thought about environment. We only thought about how much cost it will incur, how much revenues it will bring in, and what profit we will make end of the day. But today you think about, okay, I'm making this profit, but while in the process of making this profit, what damage we are going to cause to the environment. So this has become, an important point on the table. You have to consider it. So environmental accountability is there. Climate-related disclosures are given. Climate change is one of the key environmental issues of our time. Businesses and their investors need to understand the risks and opportunities presented by climate change. Now, you see, we started with financial reporting. We knew financial reporting, but now this scope is a lot beyond financial reporting. So it's not only about a business has to prepare financial statements for investors, or investors are only looking for financial statements. No, investors are looking for other information as well, other than the financial statements. Then you've got social accountability. Investors expect businesses to be socially responsible in their business practices. Reporting on social accountability now often incorporates how a business is addressing issues such as human rights and modern slavery, for example, within the business value chain. With the business value chain, for example, we will not buy from a supplier who uses child labor, and we are forcing our suppliers to create working conditions which are suitable for their workers. I tell you very honestly, because I worked in oil and gas, so we had this customers like BP, British Petroleum, Shell, Total, and they knew that we had our staff on our site, and they knew that we work 24/7 and we provide food. Can you imagine that my client is checking and asking me that what menu or what food do you give to your employees? He's not paying me money for the food. He's not paying me money for the food which I give to my staff, but he does ask me. So this is where you have a powerful customer, because not every customer can come and walk into, like if you walk into a supermarket as an individual customer buyer, you cannot go and ask that supermarket that what food do you give to your employees. You cannot. But when you have a very huge customer who has got huge bargaining power over you, and you have to listen to them. So how do you treat your how your suppliers are treating with their employees? I remember like 5-6 months ago, there was a huge debate on internet, because what happened that we know that Bangladesh is producing a lot of textiles, and those textile stuff, it goes to US and UK and Europe. And customers usually are Nike and Adidas and Levi's, etc., big brands. And the workers' conditions in those factories were not good. They were working like 16 hours or 14 hours, and the work environment is not very conducive. It's sometimes hot or cold, and they don't make it comfortable. Salaries are low. So what happened? Some of the employees, they started writing to Nike. Some of the employees, they started talking to Levi's, that I am working for this company which is supplying goods to you. So the goods which come to you, I actually put my effort in that production, but I do not get anything. These are the conditions in which I'm working. And then Levi's came in and Nike came in and starting putting pressure on those factories, on those manufacturing units, that you have to change these things. So this is where social accountability thing has come in. I mean, you could not have imagined this thing probably 30 or maybe 40 years ago. But today, these things are happening. The aim of reporting on social accountability is to measure and disclose the social impact of a business activities. Example of social measures include philanthropic donations. Now, you have CSR, corporate social responsibility, and many businesses, in fact, every business, they keep a budget for CSR. We have seen companies, they go and they clean beaches. We have seen companies, they make one drive, clean the beach. So they give everyone t-shirts, they put bags in their hands, and they find people, and society and community and company. So company is financing, they find out volunteers, and they clean the beach, or they clean some city, or they provide education to the children. They give scholarships. They have got this budget. We call it CSR budget. So you don't only have now budget for manufacturing only products and marketing budget or production budget, you do have a CSR budget as well. So philanthropic donations, whether of corporate resources, profit-based donations, or allowing employees time to support charitable causes. Employee satisfaction levels and remuneration issues have come in, and community support and stakeholder consultation information. Benefits of sustainable reporting. Now, why do we need to do it? And what are the benefits if we do it? Internal benefits, they include increase, because remember that any activity which you perform, it will have you some financial cost. So when you are talking about sustainability reporting, so it means that you need to meet some standards, you need to meet some conditions, you need to spend money on those activities. You might have, a manager who is responsible for CSR activities and etc. And it will have cost. But then you always say, I need to have my cost benefit analysis as well. So if I'm incurring this cost, what benefit does it give to me in the short term and in the long term? So you might have internal benefits, increased understanding of risks and opportunities facing the business. So business, when they remain on sustainability reporting, so it's not like that they are only giving it to the environment and to the society, but they also find out what are the risks which are faced by the business. And of course, that would help them in future. Benchmarking and assessing sustainability performance with respect to laws, norms, codes, performance standards, and voluntary initiatives. So they benchmark and they assess. Like I told you that we were given the target that you need to decrease your fuel consumption per person. You need to decrease your, carbon emission per person. So there are benchmarks and targets, and those targets are there because you gradually start going down, because a time will come and laws will be there and you will be ready to accept those laws and, how to say, follow the laws. Avoiding being implicated in publicized environmental, social, and governance failures. Otherwise, there will be social media, which is so strong. Newspapers are so strong. You make a wrong move, you do some violation, you will have a very bad name. You will have a very bad name. It's not something which is very relevant, but I'll just give you one example. It is somehow relevant that, governance failures and implicated and publicized environmental, social, and governance. I talk about 2011, and I talk about a company called BP. And the CEO of BP at that time was Tony Hayward's. And BP had this Gulf of Mexico incident. And in Gulf of Mexico, what happened that they were doing some offshore drilling in some well, and then there was oil leakage. And that oil leakage was huge, and it came to the shore. And a lot of, sea animals, sea life died during this accident because there was huge oil. So you could find hundreds of thousands of sea life dead on the water. The shores were destroyed because a lot of oil came to the shore. BP actually, what they found out that they used some technology, they used some equipment to save $14 million, only $14 million. And end of the day, BP, this incident, it cost BP $32 billion. So 32 billion means 32,000 million. And they had a lot of bad name. And most of this money, it went for compensation to all of those people who were living in this locality, compensation to all of those people who had some business interests in that area, because there was a big move against British Petroleum in the US, a huge move. Newspapers stood up, social media was there, and everyone was, blaming and calling BP that what you have done to the environment. And they actually end up paying this thing. So this much of, this could be the impact. External benefits include mitigating or reversing negative environmental, social, and governance impacts. Of course, you need to stop them, and enabling external stakeholders to understand the organization's true value, tangible and intangible assets, to make other stakeholders understand. So sustainable reporting, it does have some benefit. It is a lot of responsibility which you have to take, and it does have some additional costs, but taking that responsibility and incurring that additional cost will put you in a very comfortable position and would put you in a more in a position which is more sustainable for your future growth and for your future existence. Then comes the word integrated reporting. So we have been talking about throughout this course in IFRS, you know what was financial reporting. Today we discussed the idea of sustainable reporting. And after that, it comes integrated reporting. What is integrated reporting? It is nothing. Your financial reporting plus sustainable reporting, we call it integrated reporting. So we are focusing today when you like businesses are expected not only to present the financial reports, but they are also expected to present sustainability reporting, and together it is called integrated reporting. So the aim of integrated reporting, which we call IR, is to demonstrate the linkage between strategy, governance, and financial performance. Now, why do you do that? Because we say that, okay, what is the impact of your corporate strategy and governance, because we said that sustainability reporting also include governance, and how it has improved your financial performance and the social, environmental, and economic context within which the business operates. So how you are improving by following all these practices, these best practices, end of the day, how your financial performance has increased, how your social, environmental, and economic performance or impact has affected. So this is the purpose of integrated reporting, not only the financial side, but your impact on. So you said that my traditional financial reporting, according to traditional financial reporting, the business made $100 million, but then it caused a loss of $200 million to the environment, probably. So end of the day, this business might be beneficial for a certain group of people, but overall for the economy, for the society, this business is not suitable. Okay, so this is the same thing which I already have spoken a lot. Integrated reporting combines financial reporting and sustainability reporting with the aim of helping readers to understand three discrete elements of the value of a business: business as usual, which means your financial reporting, and the likely effect of the management's plans, external issues and opportunities, the long-term value of a business. So this is what integrated reporting it gives you. Integrated reporting, a process founded on integrated thinking that results in periodic integrated report by an organization about value creation over time. So we talk about value creation over time. Like I said that if you made a profit in terms of dollars, 100 million, but then to the environment, you caused a damage of probably 100 million. So on one side, you made 100 million, but the economy or the environment or the society, they lost 100 million. So this business has created zero value. This business has created zero value for the economy. It might have created value for a certain group of shareholders, but we said that there is not only one group of stakeholder, which is called shareholders, there are other stakeholders as well. So when you join all of them together, you are shareholder, you got 100 million, I am the environment, I got loss of 100 million. So together, if you see, business did not add any, but business did not create any value for as a whole. As a whole, there was no value creation. So we need to see how much value is created. So you might have created some value in terms of financial aspect, and then you have created some other value as well in terms of society, because you did some good campaigns, you saved environment, you educated children, you did some philanthropic activities. So that value was also created. IR framework. The purpose of the IR framework is to establish guiding principles and content elements for the preparation of an integrated report. Now, the question is that within your integrated report, which is actually sustainable report plus financial report, what would be the structure? Like financial report structure, we always knew. Financial reports, we know that there are going to be 5 financial statements, tak, 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 tak. We know that thing. What is going to be the balance sheet, how we make the income statement, we know that financial statements. But what would be the structure, elements, components of your integrated reporting? There is no fixed format for that. There is no fixed requirement, or there is no fixed elements or components of that. But there is some guidance which you may follow, because some of the things will apply to you and some things might not apply to you. For example, if you are an educational institute, you might not have any environmental impact. You have a small school, small college, you are not damaging the environment in any case. Your activities do not involve any kind of emissions to the environment. So some of these issues, they are attracted by some businesses, they attract some other issues. So, but there is a general guidance that what should be involved, and that we will discuss. So we talk about value creation. Value is created when there are increases, decreases, or transformations of an entity's capitals caused by its business activities and outputs. So we remember from past that in our financial reporting, what was our concept? That if I invest 100 and then end of the year or end of the period, my 100 becomes 120. So I created $20 value, because I only talked about one form of capital, which was, money. So if I invested $100 of my money and that become $120, I said my capital has increased and this is the value I have created. But now today we are going to discuss that money is not the only capital a business has, because we might have other forms of capitals as well. And changes in those capitals is also creation of value. Now that is very interesting point here coming up. Okay, so please pay attention to this thing now. So value creation, value is created when there are increases, decreases, or transformation of an entity's capitals. If you pay attention to the word, I'm not saying capital. So far, we have always been talking about the word capital. Here I'm saying capitals, because capitals means not only the money, but there are some other forms of capital as well, which we are going to discuss. Value may be created for the entity itself or for other stakeholders. Like I said that the shareholders, they make $100 profit, but society also get a benefit of $100. So the total value creation is $200. So you do not only think like that what shareholders are getting only, but you also talk about or think about what other group of stakeholders are gaining or losing. So that is the total value creation by a business for all of the stakeholders together. The capitals are stock of value that are increased, decreased, or transformed through the activities and outputs of the organization. This is one thing which we always knew from past, but the capitals comprise financial, manufactured, intellectual, human, social, and relationship and natural capital. So for example, if I only talk about human resource, over a period of time, the business is investing on its staff, the business is providing training and development to its staff, and the people, they become more valuable. They can contribute more to the society. They can produce better output. They can produce better products. They can produce better services. So the value of that thing has increased. So human capital is becoming more sophisticated. Your people are becoming more knowledgeable. That is also as a result of the activities of this business. So you need to calculate the impact on those people as well. So we call it human capital. So you had semi-skilled labor, but during the period of 1 year, these semi-skilled people, they all become skilled workers who can generate more value and who are more valuable resource now. Because these 10 semi-skilled workers a year ago, now I have these 10 fully skilled workers today. So that is improvement in the human capital. Just one example. The value creation process is the process by which an entity uses its capitals as inputs and converts them to outputs. An entity outputs include its products, services, byproducts, and waste. So we use a lot of capitals. So you don't only use money, but you use different types of capitals, like you use manufactured capital, like machinery. You use human capital like human resource. You use intellectual capital like, different technologies and, the intellect of your people which you use. So what type of capitals do we have? Financial capital. This is the same traditional form of capital which you already know, the money which you put into the business. Manufactured capital, equipment and tools used in an entity's production process. Intellectual capital includes an entity's formal research and development and the less formal knowledge that is gathered, used, and managed by the entity. Natural capital, these are the natural resources which are available: water, fish, trees, timber. Because it is possible that during your production process, in the beginning of the year, this was 100 and you converted it into 120. You are very happy that I made $20. But then the natural capital, which was 1,000 before, now it has become 970. So you have caused a loss of $30 to the natural capital. So you made $20 here, but this is a loss of 30 because your natural capital has gone down. So end of the day, value creation is not there. So there might be some profitability on the income statement, but overall value creation is not there. Social and relationship capital refers to the relationship in place within an entity and between an entity and its external stakeholders, such as suppliers, customers, governments, and the community. How you have improved your relationship with your customers and suppliers, and how or what happened between you and the government and the community. So these things are also important. Loss of reputation. You might face $1 million losses because of your bad reputation with your customers. Human capital refers to an entity's management and its employees and the skills they have developed through education, training, and experience. So how you are improving or increasing your human capital. So guiding principles of IR framework. There are 7 guiding principles that the IR framework requires an organization reporting to demonstrate in order to be seen as meaningful. So 7 principles there are. I'm not going to speak a lot on all of them. So strategic focus and future orientation. Remember, now this is a little bit different from your financial reporting, because financial reporting was talking about historical data. But here in your integrated reporting, you talk about future orientation and strategic focus, because we are talking about sustainability. Sustainability is not about past. Sustainability is about future. Connectivity of information. So show a holistic picture of combination, interrelatedness, and dependence of factors that affect ability to create value. Stakeholder relationships. Provide insights into nature, quality of relationships with key stakeholders and how organizations respond to their needs. Materiality. Now that's an important concept here, actually. We'll discuss it a little later because we have a different idea of materiality. You remember that in your accounting and finance, you have a material transaction. You say any transaction which can, change the decisions of users is a material transaction. If you change some information, hide some information, misstate some information, and then the hiding or misstatement could impact the decision, influence the decisions of the users, that is material information. But in integrated reporting, the concept of materiality is different than that. So conciseness, reliability and completeness, consistency and comparability. So these are the 7 principles. Actually, consistency, comparability, reliability, completeness, you already understand. These are the same terms which you use in your financial reporting, almost with the same understanding you use them here. But these are different: connectivity, stakeholder, materiality. So these are the 7 guiding principles that how your integrated reporting, you remember that you have qualitative characteristics of your financial information, 2 fundamental characteristics and 4 enhancing. So you said my financial statements should comply or should respond to these 2 fundamental and 4 enhancing characteristics, qualitative. That was financial statement. But if you talk about integrated reporting, my integrated reporting should respond to these 7 areas. So these are the 7 characteristics which you call guiding principles. Now, why do we call them guiding principle? We don't call them characteristics, because these are not essential, all of them. These are not essential, okay? It's a guidance. Content elements of this integrated report, it should include what? You should speak about, because when you prepare financial statements, you give it to shareholder. That is a way of communication. You communicate with them, you provide them information that this is how we did financially, position and performance throughout the year. So that's a message, that's a communication tool. Similarly, when you provide them with integrated reporting, you again are talking to the stakeholders. So now you are not only talking about financial side, you're talking about other areas as well. So you should be speaking about the governance issues. What is the business model? How business is managed? How business is delivering goods and services? What is the overall business model? What are the risks and opportunities which are available? And when I say risks and opportunities, I'm not talking about past, because what happened in past, it's no more a risk and it is no more an opportunity. Risk and opportunity, you only speak about something which is yet to happen, which has yet to happen. What has happened already, you call it a good event or you call it a bad event. So if there was a risk and it was materialized, it converted into an accident. So if something has already taken a place, a negative thing, you call it an accident. You don't call it a risk. So risks and opportunities, we refer to the future thing. Strategy and resource allocation. What is the overall corporate strategy and how do we allocate our resources to different activities to achieve our objectives? Performance of the business, that's the financial thing. And outlook, overall general outlook of the business, and basis of preparation and presentation. How do you estimate the numbers? Now, these are actually financial side, 5, 6, 7. How did you present the numbers? And what were the basis of estimations? Which elements do you include? Which elements did you exclude? And if you included them, how did you measure them? How did you calculate them? And then how do you present them? So these are generally, we call them content elements. Materiality and integrated reporting. Okay, so materiality and integrated reporting, like I said before, that because we have used materiality concept so many times in financial reporting and audit and assurance, we are used to what is materiality. We always thought about materiality that it has to be a number. It has to be a significant number. Sometimes we take percentages, 1% of this or 3% of that or 7% of that, etc. But here it is more than the number. So we say that in traditional financial reporting, information is material if omitting, misstating, or obscuring it could reasonably be expected to influence the decisions that primary users of financial statements make on the basis of those financial statements. This was the definition we learned from IFRS, from financial reporting. Integrated reporting consider transactions and events to be material. Now, this is integrated reporting. If they impact an entity's ability to create value for its owners in the short, medium, or long term. So any impact is material. There could be any impact or any activity. Any event that could impact an entity's ability to create value in future. So what materiality we talked about, that was in past. Now we are talking about your ability to create value in future. If somehow there is some action, there is some activity, there is some event within the company, and that event, it could cause or it could impact your ability to create value positively or negatively, either because of that decision, either because of that event, in future, your value may go up or value may go down. That is called a material event. So here the definition is slightly different. So the IS1 definition of materiality is too narrow because it mostly talked about numbers and that numbers which happened in past. It did not pay attention to what will happen to future. Integrated materiality, the materiality which is used in integrated reporting, has a very wide perspective. It has a very wide view, okay? So it's not a small view. The integrated reporting framework would also consider an item material if it helped to demonstrate that senior management was discharging its responsibilities regardless of the financial value of that item. So doesn't matter how much financially significant or insignificant that item is, but if the management is discharging their responsibilities toward sustainable reporting, that transaction or that event is also classified as a material event. Management commentary, this is going to be my last topic for this session today. It's a short thing. We will finish it in 2 or 3 slides in 5 minutes maximum. So don't lose patience. Management commentary. Commentary comes the word from comment. So it is management's comments. We have commentary on financial statements. And we do commentary on monthly financial statements. To start with, to give you the background of this idea. And to make it a very simple example, let me tell you. For example, when I was preparing my financials, so what happened that my finance manager, he brought me monthly financials. So there were 5 entities, and he brought in the financial statements every month. I reviewed them. I asked him few questions. Probably there were some adjustments which I suggested or requested or whatever. And once the financial statements are reviewed by myself, then I made comments on those financial statements, and which was called my commentary, because I had to present it to the shareholders, to the chairman, and I cannot tell him that these numbers, sometimes they look like a phone index, okay? There are so many numbers. You remember old times, phone directories, phone index, full of telephone numbers. So these numbers do not make any sense. So then I have to convert this financial statement into my commentary. And then the commentary was on the first page. My shareholder used to read those items, because I mentioned, I picked up the items which were extraordinary. I picked up the items which needed attention. I picked up the items which were not according to our expectations, maybe positive, maybe negative. Business as usual goes on. We call it management by exception. So if everything is going on as you expect that to go on, you don't need to investigate a lot. You only investigate where there are exceptions. We call it management by exception. So I presented a 1-page commentary with 5 or 6 bullet points that these are the areas which are, not in line with what we expected. And he used to read it, used to see it. He asked me 1 question, 2 questions, 3 questions, and then the question answer session started. And what happens that he was actually very good in asking questions. Giving a good answer is not a big job. Asking a good question is always very important, because it's one question probed into another, and then into another, and then into another, and finally you identify or you find out the fact. So anyways, this is the word management commentary in general, which happens in businesses and which used to happen in businesses for so many years, and it happens every month. But here, when I talk about integrated reporting, now the theme is the same. Idea is the same, but it is more formal and it is more sophisticated. So management commentary, a narrative report that relates to financial statements that have been prepared in accordance with IFRS. So it's a narrative report that first thing, financial statements have been prepared in accordance with IFRS. So I am giving a confirmation that I have followed IFRS. So no need to worry. Management commentary provides users with historical explanations of the amounts, historical explanation of the amounts presented in the financial statements, specifically the entity's financial position, financial performance, and cash flows. It also provides commentary on an entity's prospects and other information not presented in the financial statements. So what is included? You explained it, and you explained it in a way that it makes sense, because sometimes making sense out of numbers takes time, especially to those people who are not finance professionals. So they need, in a simple word explanation. And then those information as well, which is not included in the financial statements. Management commentary also serves as a basis for understanding management's objective and its strategies for achieving those objectives. We call it practice statement 1, IFRS practice statement 1, that what is the management strategy and approach to achieve the objectives of the entity. IFRS practice statement 1, management commentary, we call it. IFRS practice statement 1 management commentary is non-binding guidance issued by IASB. So it's not binding, it is a non-binding thing. Because this is for the purpose of to be presented by the management to the stakeholders. And it is something which is additional. And there are not very clear rules on that. Yes, guidance is there, but strict requirements are not there. Presentation, the form and content of the management commentary will vary between entities, reflecting the nature of their business, the strategies adopted by the management, and the regulatory environment in which they operate. So this is like, again, like I said, that it's not a very strict or stringent requirement. It's a guidance which has been provided. Elements of management commentary, that what could be included or what should be inside of that. The particular focus of management commentary will depend on the facts and circumstances of the entity. Fact and circumstances. Why I used to say circumstances? Because in some periods of time, I remember that my monthly management commentary, which was like unofficial, informal, which was coming from a CFO only to the shareholder. In some situations, it was just half a page, and in some cases, it was 2 pages. It depended on what type of projects we were doing, what type of environment, business environment was there. I remember back in 2014, there was a crisis, and there were a lot of things which went beyond our expectations. And there were a lot of things which I had to communicate to my shareholder. This is the problem, this is this thing, this is that thing. A lot of issues were popping up. So that's why we say it depends on the facts and the circumstances. However, practice statement 1 requires management commentary to include information that is essential to an understanding of the nature of the business, management's objective and its strategies to meet those objectives, entities' most significant resources, risks and relationship, and the result of operations and prospects, and the critical performance measures and indicators that management uses to evaluate the entity's performance against stated objectives. So this is actually what is happening in management commentary. You can understand that it is an interpretation of the financial statements. So whatever we have done, the financial performance and the financial statement, and the information which is not included inside, the qualitative and other sides, the risks. For example, if you talk about the risks and resources, they are not somehow presented in the financial statements there, but I need to give this information somehow. So I am actually, what I'm doing, that there is a financial statement and I am interpreting it to someone in my words, and I'm providing all the information which is from here, plus some other information which is not there, but that is something which I believe that they should know. Something I believe that I should tell them. So this is the idea, but the structure is what you are focusing, nature of business, what are the objectives, what are the strategies, what are the results of our operations. Results of operations means our financials. We have met the objectives, met the goals, or we did not meet the goals. What are our significant resources? What are the risks which we are facing? And relationship between those resources and risks and others. And that's all. And the critical performance measures, what is more important for us, and how did we do on those key performance indicators, critical success factors. So these are, in general, a picture of how to say your past performance. This is your management commentary. That's it. Okay, so this session is done. Priyesh said that it could be biased. Yes, Priyesh, it could be biased, and that's why it is not a requirement. It is not a stringent or a strict requirement. Why it should be biased? You should not say that it should be biased. You can say that it could be biased. Not necessarily the management has to be biased. or not necessarily the management is trying to, hide something or change something. Many times they are very honest. So they could be biased. And by the way, because it's a very subjective thing, and therefore it's not strictly required. It is not a requirement by IASB. It is something which they, if they can, they should do. So this is all with this chapter. We talked about sustainability reporting, integrated reporting, and management commentary. So that's all for today. A very long video. This video is going to be approximately, I think, more than 1 hour, 1 hour and 15, 20 minutes. I did not break the video because I actually couldn't imagine that where should I break, because all of these things are so much linked together that if I break this video into 2 or 3 parts, probably it would not make sense to, and some people, they might lose one part and they jump to the second part, and then they wouldn't understand what happened in part 1. So therefore I thought that I should keep it as one video.